The latest GDP report just dropped, and most people will glance at the headline number without understanding what it truly means for their investments, their job prospects, and their entire journey to financial freedom. This isn't just some abstract economic statistic, it's a critical pulse check on the economy that directly impacts your portfolio and your paychecks. So, what exactly is GDP? Gross domestic product measures the total value of all goods and services produced within a country's borders over a specific period, usually a quarter or a year. Think of it as the economy's report card. When the Bureau of Economic Analysis releases its advance estimate, like the recent first quarter 2026 report, it gives us the earliest look at whether the economy is growing, shrinking, or holding steady. A higher GDP generally signals a healthy, expanding economy, while a declining GDP can indicate a slowdown or even a recession. Now, why should you, a young adult building wealth, care about this number? Because GDP is a foundational metric that ripples through every aspect of your financial life. Let's break down its impact. First, your investments. When GDP is strong and growing, it typically means businesses are thriving. They're selling more, earning more, and expanding. This translates to higher corporate profits, which usually drives up stock prices. Companies you're invested in, whether directly or through index funds, benefit from a robust economy. Conversely, a weak GDP report can signal trouble. Businesses might see lower demand, reduced earnings, and potential layoffs, which often leads to a decline in stock valuations. Understanding this connection helps you remain calm. A single quarter's GDP dip isn't a signal to panic sell your entire portfolio, it's a data point to integrate into your long-term strategy, helping you identify potential buying opportunities if the market overreacts. Beyond stocks, GDP also influences other asset classes. In a strong economy with rising GDP, inflation can become a concern. To combat this, central banks might raise interest rates. Higher interest rates typically mean new bonds offer better yields, but existing bonds might see their value decrease. For real estate, a healthy GDP often means more jobs, higher incomes, and greater consumer confidence, all of which fuel demand for housing and commercial properties, potentially increasing property values. However, rising interest rates can also make mortgages more expensive, cooling the market. Second, your job prospects and earning potential. A growing GDP means businesses are generally confident about the future. They're more likely to hire new employees, invest in expansion, and even offer raises. This creates a stronger job market, more opportunities for career advancement, and better wage growth for you. On the flip side, a contracting GDP can lead to job insecurity, hiring freezes, and slower wage increases as companies tighten their belts. Being aware of these economic winds allows you to make more informed career decisions, whether it's upskilling during a robust period or building a stronger emergency fund during a potential slowdown. Third, and perhaps less obvious, is tax awareness. A robust economy, reflected in strong GDP growth, generates more tax revenue for the government through corporate profits and individual incomes. This can influence future fiscal policies. While you won't be directly setting tax rates, understanding the economic health helps you anticipate potential changes or opportunities for tax-efficient investing and planning, ensuring you keep more of the wealth you build. So, how do you use this information? Not by making impulsive decisions. Your journey to financial freedom is a marathon, not a sprint. Discipline is key. Instead of reacting emotionally to every GDP headline, use it as a compass. A strong GDP report reaffirms that you're likely investing in a growing environment, reinforcing your long-term strategy. A weaker report might prompt you to reevaluate your emergency fund or consider defensive sectors, but always through the lens of your long-term goals. Ownership means understanding the economic landscape your investments operate within. Investing skill means translating this understanding into calm, rational decisions, not impulsive trades. By consistently monitoring key indicators like GDP, you gain a deeper appreciation for the macroeconomic forces at play, empowering you to make smarter choices that align with your vision of generational wealth. Remember, the goal isn't to predict the next quarter's GDP with perfect accuracy. It's to understand its implications, integrate that knowledge into your disciplined investing framework, and use it to navigate toward financial freedom with confidence. Because ultimately, knowing what that headline number truly means is the difference between being a passenger in the economy and being the pilot of your financial future. looping you right back to why understanding GDP is so critical for everyone building wealth today.